Something extraordinary just happened in the silver market, and if you're not paying attention, you're about to miss one of the most significant wealth transfer events in modern financial history. Let me paint you a picture of what's unfolding right now. For decades, large institutional players have been shorting silver, betting that prices would stay suppressed. They've made billions doing this. It's been one of the most profitable trades on Wall Street. But something changed, something fundamental. And now those same institutions are trapped in positions they can't escape. The silver price just broke through a critical resistance level that hasn't been breached in over 40 years. We're talking about a technical breakout that market analysts have been watching for generations. Silver surged past $54.50 per ounce, reaching levels we haven't seen since the early 1980s. But here's what makes this different from every other rally you've witnessed. This time, the physical metal isn't there to deliver. Let me explain what that means. When you trade silver on the COMEX, you're essentially trading paper contracts. Most of these contracts never result in physical delivery. Traders just roll them forward or settle in cash. It's a system that's worked for decades because there was always enough physical silver in the vaults to satisfy the small percentage of contracts that actually demanded delivery. But that system is breaking down right now, in real time. The registered silver inventory at COMEX facilities has been draining at an alarming rate. In just 4 days during early December, over 60% of the registered silver was claimed for delivery. Think about that. More than half of the available silver that backs these paper contracts disappeared in less than a week. This isn't normal market behavior. This is panic. And here's where it gets really interesting. The market has flipped into something called backwardation. Now, if you're not familiar with that term, let me break it down for you. In a normal commodity market, future contracts are priced higher than spot prices. That's called contango. It makes sense because there are storage costs, insurance, and the time value of money. But when a market goes into backwardation, the opposite happens. The spot price, the price for immediate delivery, becomes higher than future prices. This signals one thing: desperate demand for physical metal right now. Silver hasn't been in deep backwardation like this in over 4 decades. The last time we saw this kind of market structure was during the Hunt brothers' silver squeeze in 1980, and we all know how that ended. Silver went parabolic, reaching $50 per ounce before the exchange changed the rules to break the squeeze. But this time is different. This isn't 2 billionaire brothers trying to corner the market. This is a structural supply shortage meeting unprecedented industrial demand. Let's talk about why this shortage is happening. Silver isn't just a monetary metal anymore. It's become absolutely critical to the technology that's supposed to save our planet. Every solar panel requires silver. The photovoltaic industry consumed 29% of all industrial silver demand in 2024. Compare that to just 11% a decade ago. That's a massive shift. And solar panel installation isn't slowing down. It's accelerating globally as countries race to meet climate targets. Electric vehicles are another huge driver. Each EV requires significantly more silver than a traditional combustion engine vehicle. We're talking about silver in the electrical systems, in the charging infrastructure, in the battery management systems. As the world transitions to electric transportation, silver demand from this sector is exploding. Industrial silver use hit a record high of 680.5 million ounces in 2024, marking an 11% increase from the previous year. But here's the problem. Silver production isn't keeping up. The Silver Institute projects a 1% decline in supply this year. Mining companies aren't discovering new deposits fast enough. Existing mines are depleting. And without significant new discoveries or expansions, silver production is going to struggle to meet this surging demand. We're looking at a structural deficit that could last for years. Now, let's connect this to what's happening with the short positions. Managed money short positions on the COMEX currently sit at around 12,500 contracts. That might not sound like much, but each contract represents 5,000 ounces of silver. We're talking about over 60 million ounces of silver that short sellers need to deliver or buy back to close their positions. And remember, the registered inventory just got drained by 60% in 4 days. Where are they going to get the metal? This is what we call a short squeeze. When short sellers can't find the physical metal to deliver, they have to buy it at any price to close their positions. And when multiple short sellers are trying to do this at the same time, prices can go vertical very quickly. We've seen this movie before in other markets. GameStop, Volkswagen. But those were stocks. This is a physical commodity with genuine supply constraints and massive industrial demand. The dynamics are far more powerful. Let me tell you about what's happening in London. The London Bullion Market Association reported that silver inventory levels fell by 23 million ounces in December alone, reaching nearly an all-time low. London is one of the two major physical silver trading hubs in the world, along with New York. When both markets are seeing inventory drains simultaneously, you know something significant is happening. The SLV, the largest silver ETF in the world, is also seeing its inventories dwindle. This is important because SLV is supposed to hold physical silver to back its shares. When inventories drop, it means either the fund is selling silver to meet redemptions, or they're having trouble sourcing physical metal to meet new demand. Either scenario is bullish for silver prices. Now, I want to talk about something that doesn't get enough attention: the role of central banks in this story. While everyone focuses on central bank gold buying, which has been at record levels, there's a quieter accumulation happening in silver. Central banks understand what's coming. They see the same supply and demand fundamentals we're discussing. They recognize that silver is both a monetary metal and an industrial commodity, giving it unique properties in a world transitioning to green technology. Think about the geopolitical implications here. Countries are trying to reduce their dependence on the dollar. They're looking for alternative stores of value. Gold gets all the headlines, but silver offers something gold doesn't: industrial utility. A country that stockpiles silver isn't just protecting its monetary reserves, it's securing access to a critical industrial input for future technology. That's strategic thinking. Let me paint a scenario for you. Imagine you're a major industrial company that needs silver for your manufacturing process. Maybe you make solar panels or EV components or electronics. You've been buying silver on the spot market as needed because that's how you've always done it. But now you're watching the COMEX inventories drain. You're seeing backwardation in the futures market. You're reading about supply deficits. What do? You start securing long-term supply contracts. You start buying physical silver and storing it yourself. You stop relying on the just-in-time delivery model that's worked for decades. This shift from just-in-time to just-in-case is happening across industries right now, and it's adding another layer of demand to an already tight market. Companies are essentially becoming hoarders of physical silver because they can't risk their production lines shutting down due to supply shortages. This behavior becomes self-reinforcing. The more companies hoard, the tighter the market becomes, which causes more companies to hoard. Here's something else to consider: the gold to silver ratio. Historically, this ratio has averaged around 15 to 1, meaning it took 15 ounces of silver to buy 1 ounce of gold. Right now, even with silver's recent surge, the ratio is still above 80 to 1. If silver were to revert to its historical relationship with gold, we're talking about a price that's multiple times higher than current levels. Some analysts are projecting silver could reach $80 per ounce or higher if this squeeze continues and the ratio normalizes. Let me tell you a story about what happened in 2011. Silver went from around $18 at the start of the year to nearly $50 by April. That's a 170% gain in just 4 months. What drove that rally? A combination of factors. Quantitative easing was flooding the system with liquidity. Investors were worried about currency debasement, and there were concerns about physical supply. Sound familiar? We're seeing all those same factors today, but amplified. The money printing during the pandemic dwarfed what happened in 2011. Currency concerns are higher than ever, and the physical supply situation is far more critical now due to industrial demand. But here's what's different this time. In 2011, the rally was driven primarily by investment demand. People were buying silver as a hedge against inflation and currency debasement. When that investment demand cooled off, prices fell back down. This time, we have structural industrial demand that isn't going away. Solar panels and electric vehicles aren't a fad. They're the future of energy and transportation. That demand is locked in for decades. Now, I want to address something important for those of you thinking about your financial future. If you're sitting on retirement accounts, you've probably watched the purchasing power of your savings erode over the past few years. Inflation has been brutal. The official numbers say it's coming down, but your grocery bill and your energy costs tell a different story. A lot of people are looking for ways to protect their wealth from currency debasement. One option that's worth understanding is how precious metals can fit into a retirement strategy. Gold IRAs allow you to hold physical gold in a tax-advantaged retirement account. If you have $100,000 or more in retirement savings, this might be something to explore. I put together a free guide that explains how these accounts work, how to get physical metal into your retirement account without triggering tax penalties, and what to watch out for. You'll find it in the description below. It's worth checking out if wealth preservation is on your mind. But let's get back to what's happening in the silver market right now, because the squeeze we're seeing isn't just about price. It's about the entire structure of the paper silver market potentially breaking down. For decades, the COMEX has been the price discovery mechanism for silver. Traders around the world look at COMEX prices to determine what silver is worth. But what happens when the COMEX can't deliver physical metal? What happens when the paper price and the physical price diverge significantly? We're already seeing signs of this. Premiums for physical silver coins and bars have been elevated for months. Dealers are struggling to keep inventory. Delivery times have stretched out. This is the market telling you that paper silver and physical silver are becoming two different things, and when that divergence becomes too large, something has to give. Either the paper market adjusts higher to reflect physical reality, or the paper market loses credibility as a price discovery mechanism. There's historical precedent for this. In the 1970s, the London gold pool collapsed when central banks couldn't keep supplying physical gold to suppress prices. The result was gold going from $35 per ounce to over $800 by 1980. The paper suppression scheme broke down when physical demand overwhelmed available supply. We could be watching the same thing happen in silver right now. Let me walk you through the mechanics of how this squeeze could play out. Right now, short sellers are hoping this is just another rally that will fade. They're holding their positions, maybe even adding to them, betting that prices will come back down. But every day that passes with elevated prices, their losses mount. At some point, the pain becomes too great. They start covering their shorts, buying silver to close their positions. This buying pushes prices higher, which causes more short sellers to panic and cover. It's a feedback loop that can send prices vertical very quickly. The question is, where does the physical silver come from? The COMEX vaults are depleted. London inventories are at historic lows. SLV is seeing outflows. Mining production takes years to ramp up. The only source of immediate supply is existing holders selling their metal. But why would they sell into a squeeze? If you're holding physical silver and you see this setup, you're more likely to hold tight and wait for higher prices. This creates a standoff. Short sellers desperately need metal. Physical holders won't sell. Prices have nowhere to go but up. Now, let's talk about the elephant in the room: exchange intervention. In 1980, when the Hunt brothers had silver cornered, the COMEX changed the rules. They implemented position limits and margin requirements that made it impossible to maintain the squeeze. The exchange essentially broke the market to protect the short sellers. Could that happen again? It's possible, but there are important differences this time. The Hunt brothers were speculators trying to corner the market. What's happening now is driven by fundamental supply and demand. You can't change the rules to make solar panels need less silver. You can't regulate away the structural deficit. Any intervention would be temporary at best and would likely accelerate the move to physical markets outside the COMEX system. In fact, intervention might be the catalyst that finally breaks the paper market's credibility. There's another factor to consider: international dynamics. China has been a major player in the silver market for years. They're the world's largest producer of solar panels. They need massive amounts of silver. If they decide to secure long-term supply by buying physical metal aggressively, that alone could overwhelm the market. And given the current geopolitical tensions and the push for supply chain security, it wouldn't be surprising to see China or other nations stockpiling strategic commodities like silver. Let me share some numbers that really drive home the scale of what we're dealing with. Total global silver production is around 800 million ounces per year. Industrial demand alone is approaching 700 million ounces. That leaves very little for investment demand, jewelry, and other uses. And remember, production is declining while industrial demand is growing. The math doesn't work. Something has to give. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. That's a quarter of global production going to just one sector, and that sector is growing at double-digit rates annually. Electric vehicles, 5G infrastructure, medical applications, water purification, all of these industries are increasing their silver consumption. We're looking at a perfect storm of demand growth hitting a supply wall. Here's what makes this situation so explosive. Silver is a relatively small market compared to other commodities. The entire above-ground stock of silver available for investment is estimated at around 2 billion ounces. At current prices, That's roughly a $100 billion market. Compare that to gold, which is a $10 trillion market. Or compare it to the stock market, which is measured in tens of trillions. Silver is tiny. It doesn't take much capital flowing into silver to move the price dramatically. Think about what happens if just a small percentage of global investment capital decides silver is undervalued and starts flowing into the market. We're talking about potentially hundreds of billions of dollars chasing a $100 billion market. The price impact would be enormous. And that's before you factor in the short squeeze dynamics and the physical supply constraints. Now, I want to address something that skeptics often bring up. They say, silver has been in a squeeze before, and it always ends badly. The price spikes, then crashes, and people get hurt. That's true. But those previous squeezes were driven by speculation and leverage. This time, we have genuine industrial demand that's structural and growing. We have a supply deficit that can't be fixed quickly. We have geopolitical factors driving strategic stockpiling. This isn't just speculators playing games. This is the real economy demanding more silver than the market can provide. The other thing skeptics point to is that high prices will destroy demand. They say if silver gets too expensive, industries will find substitutes. And that's partially true. Solar panel manufacturers are already working on reducing silver content per panel. But here's the reality. There's no perfect substitute for silver in most applications. It's the best conductor of electricity. It has unique properties that make it irreplaceable in many technologies. Yes, high prices will incentivize efficiency improvements and some substitution. But that takes time, years, not months. And in the meantime, demand continues to grow. Let me paint you a picture of what the next few months could look like. We're heading into a period where industrial buyers need to secure supply for the coming year. They're looking at a market in backwardation, with depleted inventories and rising prices. They're going to panic buy. At the same time, investment demand is waking up. Retail investors are starting to notice silver's performance. Institutional investors are beginning to allocate. And short sellers are trapped in losing positions with no easy exit. This is the setup for a historic move. We could see silver test $60, then $70, then $80. And if the squeeze really takes hold, if physical delivery failures start happening, we could see prices that seem unimaginable right now. Some analysts are talking about triple-digit silver. That might sound crazy, but when you look at the fundamentals and the technical setup, it's not as far-fetched as it seems. Here's what you need to understand about market squeezes. They don't move in straight lines. There will be violent pullbacks. There will be days where silver drops 5 or 10% and everyone thinks the squeeze is over. But as long as the fundamental drivers remain in place, the supply deficit, the industrial demand, the depleted inventories, those pullbacks are just opportunities for the next leg higher. The overall trend will be up, and it could be up dramatically. I want to talk about the psychological aspect of this for a moment. Most people will miss this move. They'll watch silver go from 30 to 40 to 50, and they'll think they missed it. They'll wait for a pullback that never comes, or that's so brief they miss it. Then they'll watch it go to 60, 70, 80, and they'll be paralyzed by regret and fear of buying at the top. This is how most people miss generational wealth transfers. They wait for certainty, and by the time they have certainty, the move is over. The smart money is positioning now. They're not waiting for confirmation. They're looking at the fundamentals, the technical setup, the inventory data, and they're acting. They understand that in a squeeze, the early positioning is everything. Once the move really gets going, it's too late to build a meaningful position. The volatility becomes too extreme, the premiums too high, the availability too limited. Let me tell you what institutions are doing right now. They're quietly accumulating physical silver. They're taking delivery on futures contracts. They're buying mining stocks. They're positioning for what they see coming. And they're not talking about it publicly because they don't want to tip off the market before they're fully positioned. By the time you read about major institutions buying silver in the mainstream financial press, the move will already be well underway. There's another angle to this story that's fascinating. The environmental and social governance movement, ESG, is driving massive capital into green technology. Trillions of dollars are being allocated to solar, wind, electric vehicles, and other clean energy solutions. All of that capital is indirectly creating demand for silver. The irony is that the ESG investors probably don't even realize they're creating a silver squeeze. They're focused on carbon emissions and climate change, not commodity markets. But their capital allocation decisions are having profound effects on silver supply and demand. This creates an interesting dynamic. ESG capital is patient capital. It's not trading in and out based on short-term price movements. It's committed to the long-term transition to clean energy. That means the industrial demand for silver isn't going to disappear if prices spike. The solar panels still need to be built. The electric vehicles still need to be manufactured. The demand is locked in, regardless of price. That's very different from speculative demand, which evaporates when prices get too high. Now let's talk about what this means for the broader economy. A silver squeeze of this magnitude would have ripple effects across multiple industries. Electronics manufacturers would see their costs rise. Solar panel prices would increase. This could slow the adoption of green technology, which would have political and environmental implications. Governments might have to step in with subsidies or strategic reserves. The whole situation could become a geopolitical issue very quickly. Imagine if China, which dominates solar panel manufacturing, decides to restrict silver exports to secure domestic supply, or if major silver-producing countries like Mexico or Peru implement export controls. These aren't far-fetched scenarios. When critical commodities become scarce, nations act in their own interests. We saw this with rare earth elements. We're seeing it with semiconductors. Silver could be next. The other thing to consider is the impact on the mining industry. Silver miners have been undervalued for years. Most silver is produced as a byproduct of other mining operations. Only about 30% of silver comes from primary silver mines. If silver prices spike, it changes the economics of mining dramatically. Projects that weren't viable at $30 per ounce become highly profitable at $60 or $80. But here's the catch. It takes years to bring new mines online. So even if prices spike and incentivize new production, that supply won't hit the market for years. This is why supply deficits in commodities can persist for so long. The market can see the deficit coming, prices can rise to incentivize new supply, but the physical reality of mining means there's a multi-year lag before that new supply materializes. During that lag period, prices can go to levels that seem irrational. But they're not irrational. They're the market's way of rationing scarce supply and incentivizing conservation and substitution. Let me bring this back to what matters for you personally. Whether you're an investor, a retiree, someone concerned about wealth preservation, or just someone trying to understand what's happening in the world, this silver situation is important. It's a microcosm of larger trends: the transition to green energy, the fragility of just-in-time supply chains, the consequences of decades of underinvestment in commodity production, the breakdown of paper markets when physical reality asserts itself. The silver squeeze is a symptom of a world that's changing rapidly. We're transitioning from fossil fuels to renewable energy. We're moving from globalized supply chains to regional and national supply security. We're shifting from paper assets to hard assets. These transitions don't happen smoothly. They happen in fits and starts, with squeezes and shortages and price spikes along the way. What's happening in silver right now is a warning shot. It's telling us that the commodities we need for the future aren't as abundant as we thought. It's revealing that the paper markets we've relied on for price discovery might not reflect physical reality. It's showing us that when push comes to shove, physical possession matters more than paper promises. The shorts are trapped. The inventories are depleted. The industrial demand is locked in and growing. The squeeze has begun. What happens next could reshape the silver market for a generation. This isn't just another rally. This is a structural shift in a critical commodity market. And if you're paying attention, if you understand what's happening, this could be one of the most significant wealth-building opportunities you'll see in your lifetime. The question isn't whether silver is going higher. The fundamentals and the technical setup make that almost certain. The question is how high it goes and how long the squeeze lasts. Those answers will depend on how quickly supply can respond, how aggressively industrial buyers secure inventory, and whether the paper market can maintain credibility in the face of physical shortages. But one thing is clear: the silver shorts just got trapped, and the squeeze is only beginning.